Victor Pearson, Deputy to the Chairman for External Affairs and Director of the Office of Minority and Women Inclusion. I am pleased to welcome you to FDIC's Minority and Women-Owned Investor Technical Assistance event. To fulfill a commitment made in the agency's Diversity, Equity, and Inclusion Strategic Plan, subject matter experts from our Division of Resolutions and Receiverships designed this webinar to help bridge any potential information gaps that may hinder minority and women-owned investors from participating in FDIC sales of loans retained from failed banks. Participants in today's program will learn about the bidder qualification process, mechanics of cash loan sales, and joint venture transactions. FDIC is committed to the inclusion of minority and women-owned businesses in our business activities and the broader economy. If you have additional questions, please email us at mwoboutreach@fdic.gov. Enjoy the program.
These minority and women. Thank you, Nikita, for your warm welcome and the overview of FDIC's Minority and Women-Owned Program. I'm Linda Seville, Manager of the Asset Marketing Section in the FDIC's Division of Resolutions and Receiverships. The information shared today will provide technical assistance to minority and women-owned asset buyers, as well as to any asset buyer interested in participating in FDIC loan sales. We'll go over two sale disposition strategies: whole loan cash sales and joint venture transactions, and the processes involved in each and the requirements to participate. But first, as many of you know, the FDIC retained a $60+ billion loan portfolio from the failed Signature Bank, Bridge Bank in New York earlier this year. It included a large portfolio of commercial real estate loans, many of which are secured by multifamily residences that are rent stabilized or rent controlled, an important source of affordable housing to New York City. FDIC's sale of Signature's CRE portfolio is ongoing, and we expect to close by year end. Today's presentation will not cover any specifics related to that sale. However, many of the processes described are being utilized in that transaction. In a cash loan sale, the loans are competitively marketed and sold in one or more pools to the secondary market. The loans are grouped in pools based on performance status, loan type, and other characteristics such as geographic location. Qualified bidders submit bids on a sealed bid basis, which are then analyzed to determine the highest return to the FDIC. The loan is sold for cash with the servicing released, which means the buyer assumes all responsibility for servicing the loans. The loans are sold as is, with no representations and warranties. All sales are usually closed within 20 business days after the bid has been awarded to the winning bidder. Cash sales can include loans secured by commercial or residential real estate, including second lien mortgages and home equity lines of credit. They can also include loans to businesses, commonly referred to as commercial and industrial loans, and consumer loans. The FDIC also sells certain types of specialty assets, such as agricultural loans, credit cards, leases, government guaranteed loans, or lead participations. The FDIC markets these loan types to potential bidders with specialized experience or qualifications. For instance, bidders for agriculture or ag loans must certify that they have experience with the unique features of these loans, as well as experience servicing them. The same would apply to credit cards. So the FDIC would be looking for bidders who have an established track record in the credit card business. Government guaranteed loans are also included in a specialty sale. To purchase these loans, The buyer must be an approved lender or servicer of the respective government agency providing the guarantee. Finally, participated loans, in which the FDIC is the lead lender, are only marketed and sold to FDIC-insured institutions. Now we'll look at the cash loan sale process. At the beginning of the process, the FDIC engages the services of a contractor that serves as a sale advisor to market the pools and facilitate the sale. Part of the process includes imaging and indexing the borrower's loan files to prepare for bidder due diligence. The loan files contain borrowers' confidential information, so only qualified prospective bidders are granted access to the image files. Due diligence typically lasts 3 to 4 weeks, but can be longer if the size of the loan portfolio warrants. Prospective bidders can register directly with the loan sale advisors to receive notification of upcoming sales. In addition, the FDIC also places the sale announcement on fdic.gov. Now I'll explain the due diligence process and how to qualify to participate. Due diligence is conducted online through a secure virtual data room hosted by the FDIC's contracted sale advisor. Before a prospective bidder is given access to online due diligence material, they must go through a qualification process that requires completion of a number of documents, including the confidentiality agreement, a purchaser eligibility certification, and an Office of Foreign Assets Control certification. In addition, potential bidders must be experienced in buying or selling loans in the secondary market and will be required to provide references and other information to support that experience, which will be vetted by the sale advisor. Prospective bidders must also have a minimum net worth of $1 million and will be required to post a $50,000 security deposit and execute a security deposit agreement. These requirements are in place to ensure the potential bidder is eligible to buy loans from the FDIC, to protect the borrower's sensitive and personally identifiable information, and to confirm the potential bidder's financial ability to close. The minimum net worth and amount of the security deposit are subject to change based on the type and size of the sale. In addition, the sale advisor may also have its own registration process that must be completed. Some of the due diligence materials prospective bidders can expect to see while conducting their online review include loan data spreadsheets, sale legal documents, and as previously mentioned, the image loan files. The loan files may include borrower information such as financial statements and tax returns, promissory notes, collateral documents, legal documents such as bankruptcy or foreclosure notices, and other miscellaneous documents, including borrower correspondence. Once a qualified bidder completes their due diligence, sealed bids are submitted through the sale advisor's secure online bidding platform. Before submitting a bid, there are several prerequisites that must be met. A bid deposit, typically in the amount of $100,000, must be remitted to the FDIC. This amount can be increased at the FDIC's discretion based on the type and size of the sale. An executed bid certification in which bidders certify they possess the necessary knowledge and experience and are capable of evaluating the merits and economic risks of the investment. The bidders also certify their bid is genuine, submitted in good faith, and that they have not colluded with any other bidder. And the bidder must execute a purchaser eligibility certification. This is a self-certification in which the prospective bidder certifies a number of things, one of which is that they have not caused a loss in excess of $50,000 to an FDIC-insured institution. The FDIC typically allows bidders to submit bids on individual bids, or they may combine or link multiple pools in a bid. The bidder can bid both on an individual basis and/or can submit as many bids as there are possible linked combinations. Bids must be received by the established bid deadline. Now I'll run through what a typical loan sale timeline looks like and some of the key dates. The sale is announced to the market by the sale advisor, and the bidder due diligence period begins then or shortly thereafter, and typically lasts from 3 to 4 weeks. A calculation date is established. This is the as-of date of the loan balances that bidders are bidding on and will be buying. This is a significant date since payments received on or before that date belong to the FDIC, and payments received after that date belong to the buyer. The calculation date is the same as the cutoff date in joint venture transactions that will be discussed shortly. The calculation date is typically 10 to 17 days before the bid deadline, which is another key date. During the 2 business days before the bid deadline, bidders must remit an initial bid deposit. As previously discussed, this is typically $100,000, but the amount can vary based on the size of the sale. Bids are due by the bid deadline as specified in the bid instructions. Once the bids are received, the sale advisor analyzes them to determine the bids that result in highest return to the FDIC. Asset marketing then seeks approval to award the bids to the winning bidders. The winning bidder must remit an earnest money deposit to the FDIC within 24 hours of award. The earnest money deposit is comprised of the initial deposit and a final deposit, the sum of which equals 10% of the winning bidder's bid amount. The sales are closed within 20 business days of bid award, if not sooner. And most recently, the closing is conducted using DocuSign for document execution after receipt of the purchase price is confirmed. There are a number of legal documents utilized in cash loan sales. We have touched on many of these throughout this segment, such as the confidentiality agreement, the purchaser eligibility certification, the OFAC certification, and the security deposit agreement, and the bid certification. Some of the documents are required prior to gaining access to due diligence material, and others are prerequisites to bidding. The documents that have not been mentioned include the invitation to bid, which provides the key dates in the sale, the bid instructions that identify the prerequisites to bid and explain how the bidding process works, and lastly, the loan sale agreement, which provides the terms and conditions of the sale. A sample of the FDIC's standard loan sale agreement is available for review and can be found on fdic.gov. All of these documents comprise what's called the bid package and are part of every cash sale. This concludes my presentation on cash loan sales, so I will turn it over to William Stewart for his presentation on joint venture transactions. Thanks.
Thank you, Linda. Good afternoon. My name is William Stewart, and I'm a Senior Asset Marketing Specialist in the FDIC's Division of Resolutions and Receiverships. You've just been briefed on the FDIC's cash loan sale process, which is just one of the disposition strategies used by the FDIC. In this presentation, I will be focusing on the joint venture transactions. During this segment, we'll discuss what a joint venture transaction is, why it's used, the type of assets included, how one is created, and the participants involved. We'll also look at the different bidding options in various transaction documents. Additionally, we'll walk through a typical joint venture transaction timeline and discuss the key dates and the due diligence and bidding processes. We'll also touch on what occurs at closing and during the interim servicing period until the loans are transferred to the servicer of the newly created LLC. Finally, we'll cover some of the requirements of the winning bidder, managing member, and the FDIC's ongoing monitoring and oversight responsibilities. Let's begin by asking the question, what is a joint venture transaction? A joint venture transaction is a multifaceted financial sales vehicle designed to enable the FDIC to retain an equity interest in a newly created LLC that owns failed bank assets while transferring the day-to-day management responsibilities of the LLC and assets to a private sector partner. It creates an alignment of interests between the FDIC and its private sector partner and harnesses the capital and asset management expertise and efficiency of the private sector. In addition, the FDIC and its private sector partner both share in the risks and costs associated with the disposition of the assets. So why are joint venture transactions used? To start with, the FDIC has a statutory obligation to maximize recoveries on failed bank assets and minimize losses. A joint venture transaction allows the FDIC to potentially recover more value from the assets when structured over a longer term than by an immediate cash sale at the time of or shortly after bank failure. The expectation is that the long-term intrinsic value of the assets may exceed that of the current market. As an example, during the 2008 crisis, the U.S. economy was in a depressed market and it was saturated with distressed real estate assets. The long-term intrinsic value of these assets could not be recovered in the short term if sold for cash. The expectation of a higher recovery existed over the longer term as the economy improved. This proved to be very successful in realizing a higher recovery over immediate cash sales. Now let's talk about the assets that are considered for joint venture transactions. In most cases, loans secured by real estate, either commercial or residential, are targeted for inclusion in a joint venture transaction. Commercial real estate loans include loans collateralized by office buildings, retail shopping centers, multifamily properties, hotels, and warehouses, just to name a few. Also included are acquisition, development, and construction loans, also known as ADC loans. These can be both commercial and residential and typically involve development and construction loans made for commercial real estate projects and/or single-family, condominium, and assisted living projects, as well as raw land zoned as residential or commercial. Also targeted for joint venture transactions are residential mortgages secured by 1 to 4 family residences, condos, second homes, and owner and non-owner occupied residences. In a few cases, some transactions have included a small number of REO properties. Additionally, loans from subsidiaries of failed banks may also be included. However, they must be upstream to the receivership first before the receivership can convey those to the LLC. Regardless of the loan type, the FDIC makes every effort to keep related loans or lines together within a pool. While the majority of the loans included in these transactions historically have been non-performing, they can also include performing loans. A transaction can involve assets from one or more failed banks. For instance, if a very large bank fails and the FDIC retains real estate secured assets, a single receivership sale could occur. If a large volume of real estate secured assets is not retained, the assets will be transferred to the FDIC contracted loan servicer. These assets are then held and serviced until the volume of the assets at a servicer reaches a level that would support the sale or use of a joint venture transaction or sold in a cash loan sale, as Linda just described. Now let's discuss how joint venture transactions are created. Assets retained from banks are pooled together by similar collateral types: single-family residences, commercial real estate, and ADC loans. FDIC as receiver creates a legal entity, typically in the form of an LLC. The pooled assets are then transferred to the LLC. In exchange for conveying these assets to the LLC, the FDIC as receiver is issued 100% of the equity interest in the LLC. The LLC is referred to in transaction documents as the company. Next, the FDIC as receiver will market and sell an equity interest in the LLC, generally 20 to 40%, to a third-party purchaser. The actual equity percentages can be based on a specific transaction depending on the assets in the sale, their performance, and the current economic conditions. The FDIC as receiver typically holds a majority interest, such as 80-20 or 60-40, both in favor of the FDIC. In some of these transactions created during the last crisis, incentive thresholds in the form of promotes were put in place whereby the manager's equity interest could increase if certain thresholds were met, such as a specific return on the sale of assets. Similarly, in some cases, a reverse promote was introduced in situations where the manager would achieve a certain internal rate of return based on the asset recoveries from the LLC. It's important to remember the terms of each joint venture transaction are unique to the specific loan sale and based on the characteristics of the assets in the portfolio and the size of the transaction. There are a number of parties involved in a joint venture transaction. However, the two primary participants are the FDIC as receiver, referred to as the initial member, and the winning bidder, referred to as the private owner or manager. As we just discussed, the FDIC as receiver or initial member conveys in part, and in the case of a transaction with leverage, sells in part the assets to the LLC in return for 100% equity in the LLC, and then sells a portion of that equity interest. The private owner or manager purchases a portion of the equity interest, which is paid in cash at closing. In a leveraged transaction, the LLC or company, as it's referred to in the transaction documents, will issue a purchase money note or PMN payable to the FDIC as receiver for the debt portion. The private owner forms a new entity, either a corporation or LLC, and serves as the manager. As manager, the private owner receives a monthly management fee to cover the cost to manage the company and manage and service the assets. Management fees paid to the manager have ranged anywhere from 50 to 100 basis points depending on the transaction, but typically fall around 50 basis points. Servicing fees are paid out of the management fees. Additionally, the private owner selects a qualified custodian and paying agent, subject to approval of the initial member, and a servicer that has already been qualified by the FDIC as part of the bidder qualification process that will be discussed later. There are two types of joint venture transaction, leveraged and unleveraged. In a leveraged transaction, the FDIC offers financing in the form of either amortizing or non-amortizing notes, known as purchase money notes or PMNs, issued by the LLC as partial payment for the assets conveyed by the receiver. Depending on the joint venture, there may be one PMN or there may be multiple PMNs broken into various tranches. Financing terms are determined by the risk and cash flow characteristics of the joint venture's underlying pool of assets. The coupon of the PMN is likely to be based on the specific transaction. Generally, the notes must be paid off before the equity owners receive any distributions. The PMNs may be guaranteed by the FDIC in its corporate capacity, in the case the receiver should decide to sell the notes in the secondary market. Leverage can be sized depending on the structure of the transaction, the size of the pool, or the current economic environment. In most cases, leverage is offered on a one-to-one debt-to-equity basis. In a one-to-one leverage scenario, 50% of the value of the LLC is financed by purchase money notes, also referred to as the debt, while the remaining 50% equity is split between the FDIC as initial member and the private owner or manager. Again, in most cases, the PMNs are required to be paid in full prior to any equity distributions made to the manager, private owner. In an unleveraged transaction, the FDIC does not offer seller financing, so there's no debt to be issued. In certain cases, the receiver may make borrowing facilities or pre-funded accounts available to allow the LLC to fund construction draws with respect to the assets and to meet its working capital needs. This diagram provides a visual depiction of what a joint venture structure looks like. It is not as complicated as it looks if you just break it into the parts. Again, the FDIC as receiver forms an LLC and conveys receivership assets to the LLC. The FDIC, as the initial member, then holds 100% of the equity of the LLC. When the transaction is closed, the private owner or manager pays the FDIC cash for the equity interest it's purchasing, the private owner interest. If the FDIC provides financing, then the company or the LLC will issue purchase money notes to the FDIC as receiver based on the leverage ratio set forth in the marketing information or term sheet. In most cases, the FDIC has offered one-to-one leverage, debt to equity. The manager or the private owner receives a management fee from the company or LLC for managing the LLC, the assets, and for servicing the loans. The manager contracts with a third-party servicer to service his loans, while the custodian or paying agent holds the notes and collateral documents, as well as manages payments and related accounts, such as the collection account and distribution account. There are different bidding options that may be offered in a joint venture transaction: leveraged, unleveraged, and in some cases on a whole loan, all cash basis. In a leveraged transaction, the bidder submits a cash bid for a defined portion of the equity interest, and the LLC issues a purchase money note to the FDIC for the remaining balance. In an unleveraged transaction, the bidder submits a cash bid for a defined portion of the equity interest in the LLC. For an all-cash transaction, the bidder submits a bid for the entire portfolio. The FDIC retains no interest in the assets, an LLC is not formed, and the FDIC involvement ceases. As the economy improved following its collapse in 2008, more capital became available in the secondary markets, which prompted the FDIC to begin offering to sell the loans outright for cash. Here's an example of how a joint venture transaction with leverage is calculated. The winning bid is $60 million for a 40% equity interest in the LLC. To calculate the total equity, the winning bid, and in this example, $100 million, is divided by the equity interest, in this case 40% or 0.40, which equates to $250 million. With a 1-to-1 debt to equity ratio, the debt will also equal $250 million. The total value of the LLC in this example is $500 million. The bid percentage is simply calculated by dividing the value of $500 million by the $900 million of unpaid principal balance to arrive at a price of 55.56%. The calculation does not include the issuance fee associated with the purchase money. Additionally, on the closing date, the initial member and the private owner will fund pro rata, based on their respective percentage of LLC equity, a working capital reserve account to fund custodian fees, servicing expenses, custodian fees, and funding draws. Next, we'll talk about the transaction documents. There are many documents involved, and each specify the rights and obligations of each of the parties involved in the joint venture transactions. These transaction documents cover both leveraged and unleveraged transactions. I'll run through a high-level description of each document. First is the Agreement of Common Terms and Definitions. This document governs the operations of the LLC and the rights and duties of its members, while the FDIC as receiver is the only member, before the FDIC receivership sale of a partial membership interest to the private owner. Next is the initial LLC operating agreement. This agreement governs the operations of the LLC and the rights and duties of its members, while the receivership is the only member before the FDIC receivership sale of a partial membership interest to the private owner. Next is the amended and restated operating agreement. This amends and restates the initial operating agreement and governs operations of the LLC and the rights and duties of its members. The next agreement is the asset transfer agreement. This document describes the conveyance of assets, just related to servicing and litigation, to the LLC and the receivership. Next is the custodial and paying agent agreement. This agreement sets forth the custodian's rights and obligations with respect to the custody of loan documents or collateral, and the paying agent's rights and obligations with respect to the cash management and distributions. Next is the servicing agreement, which sets forth the rights and duties of the servicer. And then have the private owner interest and sale agreement. This agreement evidences the sale of the LLC membership interest to the private owner. Next, the assignment of JDC agreement. This provides for the pledge of the JDC agreement, an agreement entered into with a contractor to manage JDCs as the collateral security for the performance of the JDC's contractor, as well as the parties contracting with JDC contractor and the company's respective obligations. The last is the letter of credit. This is a bank-issued letter of credit that serves as additional security, securing the obligations of the private owner to the FDIC as receiver. For leverage transactions, there are 3 additional documents utilized. The first is purchase money notes. As we previously discussed, this is the debt issued by the LLC to the FDIC as receiver for partial payment for the assets. Next, we have the reimbursement security and guarantee agreement, which evidences the LLC's pledge of assets for the benefit of the FDIC corporate as guarantor and security for the obligations of the LLC under the purchase money notes, including the obligation of the LLCs to reimburse the FDIC corporate for any guarantee payments. And finally, you have the guarantee. This is the FDIC corporate's guarantee of the payment of the purchase money notes. So as you can see, there are numerous documents involved in a joint venture transaction, and each one has a specific role in governing the operation of the transaction over the life of the LLC. Next, I will discuss the cash flows, their components, and how they're applied over the life of the transaction. Cash inflows generally get deposited into a collection account. This includes loan proceeds from all sources, including principal, interest, the repayment, and other related fees, as well as sales and refinancing proceeds. After the cash inflows are deposited, payments from the collection account are applied to various pre-approved charges, such as servicing expenses and required funding draws. These expenses are generally first in priority, with the remaining funds being distributed pursuant to the waterfall to pay required principal and interest on the purchase money notes, if applicable, and finally as distributions to the equity holders based on their equity split. For commercial real estate ADC transactions, the priority of payments may look like the sample waterfall outlined in this slide. First, to pay the custodian, then to the managing member its management fee, then to reimburse excess working capital advances and replenish the working capital reserve account. In some transactions, there may be a limited distribution to equity holders before the purchase money note is paid. This is called leakage. The remainder goes to the purchase money notes or to a defeasance account until the PMNs are paid in full. The last distribution made from the distribution account is to equity holders, to the members of the LLC. Next, I would like to outline the marketing and sale process used in joint venture transactions. This slide depicts a typical marketing timeline and shows some of the key dates involved in the sale. Please note that some of the activities or events overlap or occur simultaneously. There's a lot of preparation that takes place before this timeline begins. For example, contracting with financial advisor, imaging and indexing loan files, completing internal due diligence review, obtaining title reports, and site inspections. In most cases, we provide prospective bidders approximately 6 weeks to conduct their due diligence. Once bids are submitted and evaluated, we allow for approximately 2 weeks to close each transaction, followed by a 60-day servicing transfer period. First is the announcement. This is a brief announcement that is sent to prospective bidders in the FDIC's database, as well as to sophisticated investors in the financial advisors database. In some cases, the FDIC will also post an announcement of the sale on the fdic.gov website, referring any interested parties to contact the financial advisor for more information. Next is bidder due diligence. This begins at or shortly after the sale announced. The due diligence period allows prospective bidders time to conduct their review of the image loan files and typically lasts 6 weeks. However, it can vary depending on the number of loans included in the transaction and the terms and conditions of the transaction. Next is the cutoff date. This is the date in which the economic interest in the assets being sold passes to the LLC. Qualified bidders will submit their bids based on the cutoff date balances and will also close the sale using these balances. The cutoff date is approximately 2 weeks before the bid deadline. And following the bid deadline, this is just the deadline for submission of bids. This is followed by a bid award date, a date in which the transaction is awarded to the winning bidders. After bid award, we have the earnest money deposit. This is due and is typically 10% of the purchase price, due within 48 hours of award. Following bid award, a call is made to the winning bidder to discuss the closing date. In most cases, the closing date is established at the onset of the transaction, but in some cases, depending on the transaction, a mutually agreed upon date is established between the FDIC and the winning bidder when the transaction documents are to be executed, generally 15 business days after award, but could go longer. After the sale is closed, interim servicing is performed by the receivership until the servicing transfer date. The FDIC will provide limited servicing until loans are service transferred. Generally, all transfers are completed within 60 days of closing. Finally, you have the LLC monitoring. Once the sale is closed and the servicing has been transferred, the FDIC begins its monitoring of the transaction. Since these transactions are generally 7 to 10 years in length, it is very important that a strong working relationship is established with the JV partner. Now we'll discuss how prospective bidders qualify to gain access to due diligence material and what the due diligence process looks like. Similar to the cash sale due diligence qualification process, prospective bidders must execute certain documents that include the confidentiality agreement, the purchaser eligibility certification, the qualification request form, and the OFAC certification. They are also required to remit a security deposit in the amount of $250,000 and execute the security deposit agreement. Once received, the financial advisor will grant access to the prospective bidder so they can begin their due diligence. The FDIC works very closely with its financial advisor to provide prospective bidders with the most current information available from the failed institution. Financial advisor organizes the information in a manner that enables prospective bidders to perform an efficient and effective review in preparation of submitting a bid on the portfolio. The image loan files are uploaded to a secure website in a standard folder structure for ease of use. Online loan files enable prospective bidders to complete due diligence on a 24/7 basis. In addition to the image loan files, other information that may be provided include loan level reports, data spreadsheets, asset or loan summary reports, site inspections, or broker price opinions, title searches, and litigation reports. The information and data is uploaded on a regular basis. In a joint venture transaction, the FDIC conducts a sale bid sale to auction an equity interest in the LLC. Prior to the bid date, the FDIC and its financial advisor may conduct a bidder conference. This is an opportunity for the FDIC and the financial advisor to walk through the details of the bid process, including the bid form and all options available to the bidders for submitting their bids. The financial advisor will also review the term sheet, the bid deadline, and any questions that may have been submitted prior to the bidder conference. There are several prerequisites that must be met prior to a bid submission, such as the bidder must be qualified through the bidder qualification process that will be outlined in the presentation to follow by Jim Sigler. The bidder must also remit an initial bid deposit of $300,000. This amount may vary depending on the size of the transaction. As previously discussed, bidders may submit their bids under the bidding options available for the specific transaction that may include bidding on any or all pools on a leveraged, unleveraged, or whole loan cash basis. Bids are analyzed by the financial advisor to determine which bid or combination of bids may result in the highest return to the FDIC. Once the bids have been analyzed and a winning bidder selected, the financial advisor will notify the winning bidder by phone as well as in writing through a bid confirmation letter. The bid confirmation letter confirms acceptance of the bid, provides earnest money deposit requirements, sets forth documentation and funding requirements for closing, and schedules the closing date. The closing may take place in person at the designated law office. On the closing date, all transaction documents are executed and the remaining purchase price is paid to the FDIC, including the funding of any specified financial accounts. Loans in a joint venture transaction are sold on a servicing release basis. However, there is a period of time between the transaction closing date and when the loans are transferred to the LLC servicer. During this period, the FDIC receivership or initial member continues to provide interim servicing through the servicing transfer date, which is typically no later than 60 days after closing. At this point, servicing performed by the FDIC is limited to receipt and posting of payments and maintaining record of payments received. The monthly servicing fee is split 50-50 between the receivership and the managing member during the interim servicing period. Interim servicing protocols are established between the FDIC and the manager, with the manager being responsible for credit decisions. Conference calls are scheduled with the LLC servicer and the manager to discuss assets with outstanding issues. The FDIC strives to make it as smooth a transition as possible. Unlike cash sales, the FDIC's interest in the LLC remains after the transaction closes. As an equity partner in the LLC, FDIC staff monitors compliance with transaction documents, reviews asset level and entity level performance, works closely with the manager to address issues, and reports performance and projections to FDIC management and internal accounting departments. This oversight responsibility continues throughout the life of the LLC until final dissolution. This includes my presentation on joint venture transactions. Next, Jim Sigler will discuss the bidder qualification process.
Thanks, Pat. I'm Jim Sigler with FDIC's Asset Marketing Team, and this segment of our discussion will explain how prospective bidders qualify to bid on FDIC joint venture transactions. First, those interested in participating in joint venture transactions may request to be included in our list of prospective bidders to receive notification of upcoming transactions. This is an ongoing process and can be done at any time. Then once a sale is announced, prospective bidders will be required to meet qualification criteria specific to that transaction to gain access to the online due diligence materials hosted by the financial advisor. Lastly, prospective bidders that conduct due diligence may apply to bid by going through the bidder qualification process. FDIC will gather information from prospective bidders that must demonstrate their financial capacity and their expertise in managing and resolving the types of loans in the joint venture transaction. When FDIC starts to market a joint venture transaction, only sophisticated investors may be invited to participate. Investors may express their interest in these transactions by completing the prospective bidder information form, which can be found on FDIC's website at fdic.gov. The form gathers prospective bidders' contact information, asset preferences, and investor status information. Prospective bidders can identify the types of assets that they are interested in purchasing, which include not only interest in joint venture transactions, but also other types of financial assets, such as various types of securities and loan-related assets. These include loans secured by commercial or residential real estate, commercial and industrial loans, consumer loans, agricultural loans, and loan participations, as well as leases and credit card receivables. In addition, prospective bidders identify their investor status. Are they an accredited investor, a qualified purchaser, or a qualified institutional buyer, as defined by certain statutes? Once this form is completed, it can be emailed to prospective purchaser at fdic.gov. Prospective bidders that submit this form will have their names added to the list to receive sale announcements that match their expressed interests. As Pat mentioned, the FDIC engages financial advisors to assist with the marketing and sale of equity interests in joint venture transactions. The sale announcement, which is sent by the financial advisor, provides a general overview of the transaction and directs prospective bidders in how to participate. At this point, bidders must meet additional transaction-specific criteria in order to gain access to due diligence materials. Please note that transaction-specific qualifications may vary from transaction to transaction. The transaction-specific qualification process also requires bidders to complete and execute the following documents, which may sound familiar from the previous presentations. It'll be a confidentiality agreement, qualification request form, purchaser eligibility certification, Office of Foreign Assets and Control certification, and a security deposit agreement. In addition, a security deposit in the amount of $250,000 must be wired to the FDIC. The security deposit is refundable and described in the security deposit agreement. Once prospective bidders have signed the required documents and sent the security deposit, they will be granted access to the due diligence materials and may begin the review of the portfolio. Prospective bidders that submit a bid on a pool in a joint venture transaction then enter the final phase of qualification, applying to bid. The financial advisor will provide a bidder application and instructions for prospective bidders, and those interested complete this application and supply supporting documentation. Now, up to this point, the qualification process has qualified on providing prospective bidders with sufficient information to make a decision to bid. The application and information supplied by the prospective bidders provides FDIC with details regarding the bidding team, their structure, and should demonstrate the team's ability to close the transaction and manage the portfolio. FDIC actively underwrites each application and uses the information to determine whether the prospective bidder has the requisite financial resources and managerial capabilities to be a successful bidder, and to ensure that their background, such as recent bankruptcy or a criminal conviction, would not make it inadvisable for the FDIC to allow them to participate in the transaction. In addition, any insured depository institution that contemplates participating and bidding in a joint venture transaction must obtain their regulatory approval to submit a bid. There's a significant level of activity that takes place behind the scenes as we work every application and analyze it. The bidder qualification application has two sections. Level 1 that covers the prospective bidder's proposed acquisition structure and legal background, and Level 2 that addresses their financial background, funding, asset management, and servicing qualifications. Level 1 requires a depiction of the team's organizational structure that includes the lead bidder, the private owner, servicer, asset manager, and all investors contributing over 25% of total funding for the acquisition. This can be in the form of an organizational chart or a bubble diagram that presents the relationships between the entities. Bidding teams must also identify the key decision makers for the LLC and for asset management functions. Once prospective bidders represent the organizational structure in their application, no organizational alterations are permitted as it relates to the key decision makers or the private owner and other members of the team. FDIC must ensure that the team we qualify through the application process will be the team that closes the transaction. However, the FDIC does permit name changes and other minor adjustments in the private owner. Usually this entity isn't even formed until a winning bid is selected. Bidders may also change allocations between investment capital sources, so long as all the required investors have been vetted. Level 1 also includes a questionnaire on the legal background for the lead bidder and investors. Additional information is required is dependent on the responses to these questions. Lastly, this section includes a place for prospective bidders to provide minority and women-owned information on the entities that make up their team. In a joint venture transaction, the prospective bidders are forming a long-term relationship with the FDIC. The qualification process must verify that the bidding teams have the experience and capability to handle the day-to-day business of the LLC. As such, FDIC evaluates the information on that prospective bidders provide in the 4 areas covered in Level 2. The first of these areas is financial background and information such as credit ratings, financial statements, and Dun & Bradstreet reports. Second area is funding. FDIC must ensure the bidding team has the financial means to close the transaction and to fund ongoing obligations of the LLC. Information on available cash and cash equivalents, bank statements, commitment letters, and documentation of callable capital must support the bidding team's financial capability. If the bidding team is forming a new entity, FDIC will collaborate to support this. However, even with a new entity, sources of funding should be clearly identified. Most portfolios offered in a joint venture consist of loans, so the ability to service the type and volume of loans in a specific transaction is important. If a bidder doesn't have this capability itself, a competent servicer must be identified to be part of the bidding team. The third area that prospective bidders will be evaluated on is asset management and servicing capabilities. Prospective bidders must provide information about their servicer that includes servicer ratings, any relationships they have with subservicers, and information on the current portfolio already being served. They must also describe their operational experience of their managers and key employees, as well as their experience with default management and loss mitigation. Finally, they must explain disaster recovery plans and data security processes that are in place, as well as their call center operations that can effectively work with non-English speaking borrowers. This last item is particularly important with single-family transactions. For the FDIC, the goal of a joint venture is to maximize recoveries and to support our statutory requirements. Thus, a bidding team's plan for working the assets in the portfolio is required. This is a high-level plan as opposed to a strategy for each asset. However, the plan needs to be detailed enough to demonstrate the specific expertise to fit the needs of transactions portfolio. Which leads to the fourth area that is evaluated, the prospective bidder's portfolio management plan. This plan should cover the asset management planning abilities such as timeliness and schedules, their overall strategy that demonstrates how they will transition and control the portfolio, the direction they plan to take to optimize value, and how they will ultimately exit. It should also include the operational capacity that demonstrates roles and responsibilities and key functions within the organization as well as servicing. And finally, the plan should describe the disposition and marketing strategy for the assets. Again, in an effort to promote diversity, FDIC also asks that the prospective bidders disclose the minority and women-owned businesses that are part of their bidding teams. Now let's take a look at a typical qualification timeline. It all starts when online due diligence is made available for prospective bidders, which is approximately 6 weeks before the bid deadline. At that time, the financial advisor provides the bidder qualification application and application instruction to prospective bidders that are conducting due diligence. The application is generally due 3 weeks before the bid deadline, at which time prospective bidders submit their application and supplemental documentation to an FDIC designated virtual data room. Bidding teams do not have to have a completely finalized bidding strategy when the bidder application is submitted. However, prospective bidders need to provide sufficient data about the team and its resources to justify acceptance of the application. The qualification process treats each applicant as if it will be the winning bidder. Should questions about an application arise, the FDIC will reach out to the bidding team and collaborate as we work to approve each team to bid. Then approximately 5 days before the bid deadline, the financial advisor will notify each prospective bidder as to whether they have been approved to submit a bid and complete other bidding prerequisites, such as remitting the bid deposit. This concludes my portion of this presentation, and I'll turn it back over to Linda for some final comments.
Okay. Thank you, Jim and William, for your informative presentations. As you've seen, there's a lot that goes into conducting a cash loan sale and even more with joint venture transactions. While many of the processes for these two disposition strategies are the same, there are also a number of differences due to the complexities associated with joint venture transactions. Now I'd like to show you how to find information about these strategies on FDIC.gov. Please go to FDIC.gov and then you will click on Resources at the top of the page. Scroll down to Resolutions, then click on Learn More About Resolutions. Once you've clicked on Resolutions, you'll need to scroll down again to Asset Sales and click on Learn More About Asset Sales. The Asset Sales page includes information on loan sales and joint venture transactions, as well as other types of FDIC asset sales. And finally, the link to historical sales will provide loan sale and joint venture transaction sale results for the past 10+ years. We hope you've found these presentations helpful. If you have any questions, please send an email to assetmarketing@fdic.gov and we will be happy to answer them. And enjoy the rest of your day. Thanks.